To start, maybe you could introduce yourself and the wider team that help manage the strategy.
So my name is Ryan Myberg. I'm one of the 3 portfolio managers on our global sustainable total return bond strategy, alongside Chris Diaz and Colby Stilson, who have been partners of mine for a long time, even predating our move to Brown Advisory, and supported by a broad team, but also working very closely with our equity colleagues and other investors across the firm to harness the best ideas that exist here at Brown Advisory to deliver the risk-adjusted returns that our clients are looking for.
And maybe you could give us a bit of an overview of the strategy itself.
So it is an unconstrained global strategy that looks to deliver both traditional performance, but also impact. And we do that by underwriting everything that we own using deep dive fundamental and sustainable research. And it really is truly go anywhere. We are big believers in the power of diversification. And so we think about where we are in the economic cycle, where are the opportunities, both by asset class and geography. And we think about it in terms of the long term. The length of time that we invest is really long form. It's thinking over the next 3 and 5 years, not just in terms of traditional performance, but also the amount of time it takes to deliver impact to all the investments that we make.
And why should a client consider an unconstrained, sustainable portfolio?
What we've always found in managing global fixed income portfolios, especially with a really broad remit, is that during the course of an economic cycle, there's always these different opportunities that pop up. They can be different in the context of where we are in the economic cycle. So it might be a certain asset class that's more interesting than another. It could be something that's much more idiosyncratic in terms of geography, where we have more opportunities, say, in Europe than in the US. And so by being really global, and casting the widest net in terms of finding opportunities, we can really take advantage of what's out there in the market. And what we found as well is that it really allows us to lean into where the opportunities are, but also to be able to really produce diversified portfolios that can really smooth the ride for our clients as we think about the type of return stream that they're looking for in fixed income over the long term.
And what's really underpinning the investment philosophy for you?
One of the nice things about having been a team for a long time is that we have these key tenets that we focus on. It's risk-adjusted returns over the long term. It's capital preservation when markets are difficult. But when you've done it together for a long time, you can take your philosophy and you can really distill it down into the principles that are the most important to you, but also the ones that you hope really differentiate you in the context of you versus your peers. And for us, there are 3 that really stand out. And the first is our investment process. We're big believers that investing in global fixed income means that you have to really think about both the top down and the bottom up. When we manage money through the cycle, you have different phases of the cycle. You have peaks and troughs, you have ups and downs. And we've always found that you have to have a macro lens through which you view risk and manage risk. But at the same time, we're big believers in the power of fundamental research. It's very consistent with the firm at Brown Advisory, that commitment to doing the work in terms of the investments that you make. And so we don't shy away from that. The fundamental research is what delivers the really strong risk-adjusted returns over time. But where we think we're different is where the bottom up really influences how we think about the economic cycle. And we ask all of our analysts to share with us the information that they get from the companies that they speak to. You ask management teams about their businesses over the next 1, 2, and 3 years. They're very forward thinking in terms of their business models. And we ask them about supply chains and input costs and labor markets and CapEx intentions. And that gives us a really good steer. It's really forward-looking in the context of the economic cycle and helps us to really position our portfolios for the long term.
And the second thing that's really important to us is sustainable investment research. I think what we realize in fixed income is that we manage a very asymmetric asset class where our upside is relatively limited and our downside can be 0. And so any lens that we can view and understand risk through is incredibly accretive. But if you believe, like we do, that sustainability considerations are becoming more and more economic over time, the companies and the countries that will do a better job of improving their opportunities and risks associated with these will be the outperformers.
And the third one is, the reality for us is, having managed fixed income portfolios for over 20 years each, that the market's changed a lot. And ultimately, benchmarks are very flawed in the sense that they are comprised of the most indebted companies and countries on the planet. When we started our careers all those years ago, the global aggregate benchmark had 4.5 years of duration, and now it's closer to 7. And so benchmarks have so much embedded interest rate risk that can be very challenging in certain market environments. And so for us, we're aware of benchmarks, aware of the market, but we don't feel compelled to have to manage to a benchmark. We've always felt that with a blank piece of paper, and by assessing the economic picture and looking at all the different asset classes and geographies available to us, that we can build really robust portfolios that can be the core fixed income allocation for our clients, and that can perform in almost any market environment.
And thinking about your clients, how would they typically use this strategy in terms of asset allocation alongside other managers?
This strategy it's a core allocation for fixed income. It's meant to be owned through the economic cycle, and it will be suited for risk-on environments and risk-off environments. And really it can be that core allocation that our clients can use to then build around. So adding to high yield or emerging markets or adding equity risk alongside of it. And we really think about it in that way. We don't exist in a vacuum. Ultimately our role is to be that core fixed income allocation to protect on the downside when markets are challenging, while still being able to participate when markets are doing well. We have all those levers to pull to be able to do that. But it's really meant to be a key building block for our clients as they think about performance, but also it's about impact as well. And what we're seeing from our investors is that there's this migration to strategies that can do both, deliver the performance that they need, but also to help to solve these existential issues that we face, whether they're environmental or social issues. And that's what this strategy does. By underwriting all the investments that we own, not just with fundamental research, we can have a really good sense of the type of impact that each of those investments can make to help to solve these challenges that we face.
And you touched on it there, but how does the strategy navigate these changing market conditions and different economic landscapes?
Well, we really think about it at the highest level, which is taking a look at all the major economies on the globe and getting a really good sense of where we think we are in the cycle. And as we think about it, we break the economic cycle into 4 different phases. And every phase is different, recovery all the way to trough. For us, it means a different level of risk depending on the market environment, but also it means a different allocation of risk, meaning that in healthy market environments, so that recovery phase coming out of recession when spreads are at their widest and fiscal and monetary policy are at their easiest, we run the highest levels of portfolio risk. And the composition of that risk is heavily skewed towards risk assets because you're getting compensated to take that type of risk. But on the flip side, and this is really important, when you get into more challenging market environments, when you're going into a slowdown or into recession, we run the lowest levels of portfolio risk. And the composition of risk completely changes, where we run very low levels of corporate risk, for example, much higher levels of risk-free duration, treasuries, gilts, and bonds, so that we can be defensive and we can be that counterbalance or that counterweight to the equity risk or the private risk or the other risks that exist in clients' asset allocation mixes.
And then finally, what might viewers want to know about you as an investor that they may not have considered?
Well, I studied foreign affairs as an undergraduate. I was always really passionate about geopolitics and how it influenced the world. And when I was thinking about what I was going to do for a career, I realized that global investing satisfied all the interests that I had. It was politics, it was economics, it was technology and science. It was all these things sort of brought into one. And it's this amazing opportunity for me to scratch the itches that I have. It's about learning, it's about reading, it's about being surrounded by really smart people who are driven and like to compete. But what I also realized is the best place to do it is in London, because it is the sort of the center of the financial world. I get to invest in Asian markets and European markets and US markets. And so it's a really, really gratifying job to be able to work with people that are really driven. We get to compete every day. We can see the scoreboard based on performance where we sit in the peer group. It's something that I'm very passionate about and very lucky to be able to do.